I'm the dumbest guy in the world. I just lost $2.5 million. Gold is what you own when you want a reserve asset with no counterparty or no political leash and no shutoff switch. To see a central banker come out and say, we own gold because when someone cuts off the power to the global financial system, this is what will allow us to not fall into the ashes.
So according to Bloomberg, the AI model called Mythos, built by Anthropic, has the potential to fundamentally transform and destabilize cybersecurity across the global financial system. They called in this emergency meeting. In the room, you had Citigroup's Jane Fraser, Morgan Stanley's Ted Pick, Bank of America's Brian Moynihan, all the big guys, Wells Fargo's Charlie Scharf, Goldman Sachs's David Solomon. The only guy that couldn't make it was Jamie Dimon. And of course, this matters to everyone because we all have our loans, our deposits in these banks. You have an AI cybersecurity hack, the entire system could go down. And
why are the central banks prioritizing physical gold over anything digital? Paul Barron, he's the first person on the tech side of things in crypto that legitimized and said, yeah, it's a very frightening thing.
But Bank of America, and we'll bring it back to the markets and commodities, the chief investment strategist there, Michael Hartnett, says that investors should be moving into commodities for the next several years, arguing that the second half of this decade will be defined by geopolitical tension, inflation risk, and as you said, a structurally weaker dollar. So he sees commodities replacing stocks and bonds as the biggest winners for the rest of the 2020s. Also, BlackRock made a very interesting call, the third time that it's done this in 50 years, away from long-duration U.S. government bonds and towards other assets, more specifically abandoning its 60-40 portfolio, stocks and bonds, which we know has long been considered the foundation of modern investing. But BlackRock is shifting towards what it calls a Plan B diversification strategy, not tied to financial engineering per se, but to economic strength. And capital is rotating into 4 key commodity plays: gold miners and streamers, copper, uranium, and energy producers. Not gold per se, but gold miners and streamers. They say gold doesn't give you enough upside, but they want the gold miners and the gold streamers for that, exponential upside. But they're focusing to what you could say are the building blocks of the real economy.
What looks like a routine portfolio adjustment may actually be a quiet admission that the old diversification model is losing credibility. As Andy Schectman points out here, major institutions are no longer treating bonds as reliable protection in a world shaped by sticky inflation and geopolitical stress. BlackRock moving away from the classic 60-40 framework matters because that model has anchored retirement portfolios for decades. The strongest signal is not gold itself, but the move toward miners, copper, and uranium, which suggests firms are positioning for supply strain rather than short-term momentum. Next, Andy Schectman discusses why institutional money may already be moving faster than the public realizes.
That, along with Bank of America saying commodities. Now, look, I've been doing this a long time. And for the longest time, I've been saying the super cycle, the commodity super cycle is just around the corner, just around the corner. But now we're hearing the mainstream saying this as well. What say you?
Michael Hartnett is, his newsletter is many thousands of dollars per year. It goes to the institutional traders. This is the same guy that came out and said, right after the chief investment officer for Morgan Stanley came out earlier this year and said the 60-40 model that BlackRock is now revising, said it's dead. Sell half of your bonds to 40% and put 20% into gold. Michael Hartnett said no, it should be 25% stock, 25% bond, 25% short-term treasury, 25% gold and silver. The lead metals guy for Bank of America just came out and said that he could see silver this year between 130 and 309. Jeffrey Gundlach, the bond king, came out and said 25% allocation to precious metals is not overweight. This is a dude that made his living, his moniker, his reputation on selling the antithesis of gold, an instrument that pays a yield. You're beginning to see it, but here's an interesting point. I have a dear friend. He's a good friend, and he also is a money manager that I do some business with at Morgan Stanley. And he wouldn't know a gold coin if it fell on his damn foot. And his chief investment officer, he is one of the biggest money managers in the state of Florida. He runs $4 billion. He's Kevin's brother-in-law. And the chief investment officer of his firm is saying, you should sell half of your bond portfolio and put it into gold. It hasn't trickled down yet. Michael Hartnett is speaking to the institutional traders. Jeffrey Gundlach is speaking to the institutional traders. So too is the chief investment officer of Morgan Stanley. They're speaking to the institutionals, not to us, and not even to the big guys that are managing $4 billion in the state of Florida. My point to you is that this is a whole different strata of people that are moving before the crowd. Could these be the people that are standing for delivery every single month?
The bigger story here is not the commodity call itself, but who is quietly changing their allocation models first. As Andy Schectman points out here, when bond-focused managers begin treating a 25% metals position as reasonable, that marks a major shift in institutional thinking. For years, gold was viewed as a fringe hedge, yet now private research desks are discussing it beside stocks, cash, and treasuries as a core holding. Retail investors usually hear these changes after prices have already repriced, not before. Next, Andy Schectman unravels whether physical delivery demand is revealing who is moving before everyone else.
Could these be the people that have been every month for 18 months spending billions and billions of dollars when less than 1% of contracts ever move to delivery? Now we're seeing huge amounts. Could it be those folks? Maybe, probably, yes. And I think that you should listen to Michael Hartnett. He's a very smart dude. He's paid a lot of money to speak to the institutional traders. I try to read him as often as I can, and I've cited him a lot. And all I can tell you is that's not a small thing. But the thing of it is, you turn on any financial media, any that you can find, and not one of them will speak to this. Not one of them will. So this is way up at the insider level by the time it becomes obvious.
They were talking about gold for a little bit as gold was making new all-time highs like practically every week. It was getting mainstream attention.
Not in the right vein.
And then Larry Kramer said buy gold, and as usual, that was the reverse indicator because
Jim
of price.
Cramer, right.
Jim Cramer, that's right.
But none of them captured the most important thing. Buy gold, it's going up. Well, they would always talk about it being, well, could it be oversold? Could it, blah, blah, blah. But they never said buy gold really as much as they talked about its price.
Sometimes what financial television refuses to discuss tells investors more than the segment itself ever could. As Andy Schectman points out here, delivery demand staying elevated for 18 straight months in a market where under 1% normally settles physically deserves far more scrutiny than price chatter. Instead, media coverage stays trapped on whether gold feels overbought, while ignoring who may be removing supply behind the scenes. That disconnect matters because institutional behavior often signals deeper stress before price fully reflects it. Next, Andy Schectman talks about why mainstream forecasts may still be understating where this market can go.
What they missed was who's standing for delivery every single month at levels that no one has ever seen before. These are the most well-informed traders on the planet. They've missed that. And then they piled on when it corrected, ignoring the important things. Speak to interest rates going up, and that's why gold's falling, ignoring that it went up 400 basis points over the last few years, and gold tripled. It's the mainstream financial media is the worst thing that ever happened to the investors in this country. They would get far better performance out of their portfolio by doing nothing other than listening, reading X, and watching YouTube.
And that's give a price forecast.
Oh boy.
And I always put you on the spot, and I always want to get a price forecast from you. I will say this, that Swiss bank UBP, not UBS,
6,000.
UBP, 6,000 gold by year end. Goldman still has it at 5,400 by year end. UBS projects the gold prices to reach a range between 5,900 and 6,200 an ounce by the end of 2026. I mean, we had Jim Rickards on the show recently who said he still sees $10,000 gold as a possibility by the end of this year. He still has not ruled that out.
One of the most interesting guys I've ever talked to.
You can watch that video to see how he gets there. JP Morgan says 6,300, Deutsche Bank 6,000, Bank of America targets 6,000 over the next 12 months.
Jeffries 6,700.
But what is Andy Schectman?
I don't know. I think just listening to all those, you keep hearing the number 6. Okay, again, it's a guess. It means nothing to me. But 6,000, sure. I think prices will go higher than people think possible in dollar terms specifically. And it's important to note for silver as well. You're seeing high numbers as well. And the lead metals analyst for Bank of America is saying it can go to 309, I think was the number he said. But the point of it is that you're seeing all of the mainstream folks, not only at very high levels, not only endorsing higher prices of gold, but they're endorsing the highest allocations of it in your portfolio I've ever seen before.
The most overlooked contradiction is that gold climbed even while rates rose more than 400 basis points. As Andy Schectman points out here, that alone challenges one of Wall Street's favorite narratives, that higher yields automatically suppress precious metals. Now, several major banks are clustering around a $6,000 target, and when independent firms begin repeating the same range, investors should notice the pattern. The more important shift may be rising recommended allocations, because that changes portfolio behavior, not just price expectations. Next, Andy Schectman discusses why silver could become the more volatile side of this same institutional move.
Higher than people think possible, higher than it is today. And in that article, I read that article too about the Swiss bank. They sold at the beginning of the war because they saw the sell-off, and now they're reaccumulating again. So they think it's coming, and so they're buying again. Smart, they saved a little bit of money, sold at the top and buying again here, but they, to see it over $6,000 would not surprise me one bit at all. I mean, look, from a percentage standpoint, it's not that far away,
Yeah.
We've seen a market that doubled in a year. To expect it to move up 15, 20% in the face of massive inflation and higher energy prices and more military spending and a crazier world isn't that far, I think, of a stretch.
A 15% move sounds modest until you remember how rarely major institutions reverse course this quickly. As Andy Schectman points out here, the real signal is not the $6,000 target itself, but the fact that large banks sold into panic and then quietly started buying again. That kind of repositioning usually reflects changing internal risk models, not emotional trading. With energy costs rising and sovereign debt expanding, a 20% move in gold would be smaller than many investors assume in real terms. Next, Andy Schectman discusses why technological threats could become the next hidden driver behind safe haven demand.
So according to Bloomberg, the AI model called Mythos, built by Anthropic, has the potential to fundamentally transform and destabilize cybersecurity across the global financial system. So they called in this emergency meeting. In the room, you had Citigroup's Jane Fraser, Morgan Stanley's Ted Pick, Bank of America's Brian Moynihan, all the big guys, Wells Fargo's Charlie Scharf, Goldman Sachs's David Solomon. The only guy that couldn't make it was Jamie Dimon from JP Morgan. He was not able to attend. But these are the banks that are classified as systemically important, meaning a breach of any one of them could send shockwaves through the international financial system. And it's all, again, linked to this Mythos, which is the Anthropic's most powerful AI model to date. I'll give a little bit of background here, because I know AI is not necessarily your field of expertise, although you do know quite a bit about this, but this wasn't designed specifically for hacking. This is advanced coding and reasoning capabilities of AI that have given it the ability to find and exploit software vulnerabilities that human security researchers missed for decades. And according to Anthropic's security team, Mythos has already identified thousands of previously unknown zero-day vulnerabilities across every major operating system and web browser.
What could possibly go wrong?
Right. We won't get into too much of the details, but the idea here is that it can find these flaws, but then it can link multiple vulnerabilities together and it could construct working exploits. And the concern is what happens if a tool like this ends up in the wrong hands, or when a competing lab builds something similar without the same safety guardrails. And they're warning that these banks need to understand that they're not sufficiently defended against these AI-powered attackers that can find exploits faster than any human security team could patch them. And of course, this matters to everyone because we all have our loans, our deposits in these banks. You have an AI cybersecurity hack, the entire system could go down. And
Markets price inflation daily, but almost nobody is pricing digital fragility into financial valuations. As Andy Schectman points out here, when the largest banks hold emergency meetings over AI-driven cyber risk that deserves more attention than another routine Fed headline, Thousands of zero-day vulnerabilities suggest the banking system may be more exposed than depositors understand. Investors often treat financial institutions as defensive holdings, yet a technology shock could hit confidence faster than a credit event. Next, Andy Schectman talks about why even one major banking failure could ripple far beyond a single balance sheet.
Even if we said just one of the banks goes down, that is systemic.
Yeah, and again, stuff I've been talking about for a long time, and I'm going to read something to you that I talked about maybe 2 years ago, for sure 1 year ago. I don't know if it was, but it was a long time ago. And I when you told me you wanted to chat about this, I'm like, I've been talking about this for a while. But before I read that, I also talked about, I don't know, almost a year ago, the Google Willow chip. I've spoke about it a bunch. The Google Willow chip is a prototype that does what the world's fastest supercomputers can do. It does in 10 minutes what the world's fastest supercomputer right now can do in 10 septillion years. I didn't know what septillion was. Nobody does. It's like 10 to the 25th power. You're talking long before, Neanderthals were stalking the plains of Europe.
The market still treats exponential technology as a story, while systemic risk continues to be priced linearly. As Andy Schectman points out here, one major bank failure in a digitally linked system no longer stays isolated the way investors once assumed. The mention of quantum-level processing matters because risk models built on historical banking stress were never designed for machine-speed disruption. Portfolio managers may be underestimating how quickly trust can vanish when technology moves faster than regulation. Next, Andy Schectman unravels why central banks may already understand this vulnerability better than most private investors do.
That's how long ago that was. And I will just simply say to you, that's just a prototype. And when you and I went to dinner with Paul Barron and talked to him about this, he's the first person on the tech side of things in crypto that legitimized and said, yeah, it's a very frightening thing.
Yeah.
It's a very frightening thing. Paul's a very smart dude. And I said, what happens with quantum computing? So all of these things that have been exploited and exposed, there was no vulnerability. What are you talking about? It's unhackable. Really? Well, here's thousands of potential hacks. Well, what about quantum computing? But I want to read something to you, Michelle, because I found this to be, and when I talked about it and read it a million times 1.5, 2 years ago, to me, it's just like ding, 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 ding. When you hear this coming from a central banker, you ought to pay attention, all right? This is coming from a man named Adam Glapinski. Adam Glapinski is the head of the Polish bank, central bank. Poland has been buying more gold than anyone in the world for the last couple of years. And here's what he had to say. He was asked, why is Poland buying all this gold? In Glapinski's word, gold keeps its value even when someone cuts off the supply to the global financial system. And he also stressed that gold has no counterparty risk and cannot be devalued by another country. He says when someone cuts off the power to the global financial system, a system that is largely digital, what happens? And when you have a central banker saying, well, someone cuts off the power to the global financial system, this is why we own gold. What Poland understands is that real power in the modern system lives in the plumbing of the payment rails, the custodians, the clearinghouses, the reserve issuers.
Central banks rarely explain their fears directly, but sometimes their buying patterns say enough on their own. As Andy Schectman points out here, Poland accumulating gold while warning about failures in digital finance reveals concern that goes beyond inflation alone. Gold is being treated less as a trade and more as infrastructure insurance against a system built on electronic trust. That distinction matters because most retail investors still view metals through a price chart instead of through systemic resilience. Next, Andy Schectman discusses why physical ownership may matter more than paper exposure if confidence in financial plumbing starts breaking.
Gold is what you own when you want a reserve asset with no counterparty or no political leash and no shutoff switch. And that's, to see a central banker come out and say, we own gold because when someone cuts off the power to the global financial system, this is what will allow us to, not fall into the ashes. That's a big deal.
But are we saying that if we do have this hack, which is practically, I would say, more chances that we will have it than we don't, that at some point the digital infrastructure faces a major hurdle, even though we've had this meeting and asking banks to be prepared? Are we saying that people that have physical gold are now going to start pulling it out and trading with physical gold?
Well, let's
I
hope
mean,
not, but let's look at it the other way. Are you going to be happy when the entire network that is your life and your livelihood, and no one has any cash anymore, and no one has anything to trade with? This is obliterated for who knows how long? I mean, you know,
and people don't even keep paper records. I do, but most people don't even keep paper records of what they own in the banks. It's all digital now. So I guess if there is some major hack, some major AI, cyber security disaster, all the digital records could be gone.
are we to believe that it will never fall into the hands of any entity that would like to destabilize or hold ransom, hold hostage the U.S. markets? I mean, it's all but guaranteed it's going to happen, and I find it to be naive when people say quantum.
But how does having gold help you then?
The real warning here is not about gold rising, but about confidence in digital finance quietly weakening underneath the surface. As Andy Schectman points out here, central banks are openly treating gold as insurance against a system that can be frozen, hacked, or politically restricted without notice. Most investors still assume account balances are permanent because the screen says the money is there. Yet if payment rails fail, even briefly, liquidity can disappear faster than traditional portfolio models account for. Next, Andy Schectman discusses why physical assets are being viewed as backup systems instead of simple speculative holdings.
It's an asset when everything else is locked down. I mean, would it have helped you in what was it called? Greece, not Greece, right next to Greece.
Cyprus?
Cyprus would have helped you when everything went down. Maybe, I don't know. I don't know, but I can tell you that if everything is digital, if all wealth is digital, if all money is digital, would you rather have something that has value and could be traded? Now, I'm not telling people to buy gold because we're going back to the Stone Age, but what I am simply saying to you is that would you not at least like to have a fallback when the entire system is
some analog
compromised?
diversification.
Yes.
Some analog diversification, especially as things are becoming more and more digitized, more and more tokenized. And that's a whole other conversation for another time.
And why are the central banks prioritizing physical gold over anything digital or over Bitcoin? Because it's the same thing. They're prioritizing the physical possession outside the digital matrix. And you could argue with the digital ID and the Genius Act digital money coming in January of next year, everything is moving digital. Being outside that system ain't a bad idea, because just like all of these things are progressing, so too are the bad guys in their ability to compromise, hack, steal. You know, you lose it all real quick. In fact, you know, I know one of my clients last week called. He must have emailed me, texted me, and called me 55 times while I was out of town.
What sounds old-fashioned today can quickly become practical when financial systems become entirely dependent on access. As Andy Schectman points out here, the phrase analog diversification matters because it reframes gold as a parallel form of security, not just a commodity trade. Central banks are choosing physical possession while governments push further toward digital money and tokenized systems. That contrast should make investors ask why policymakers trust digital infrastructure while reserve managers still prefer something tangible. Next, Andy Schectman talks about how one personal loss can expose the larger vulnerabilities many investors still ignore.
Finally, he answered, "What's going on, man?" He's like, "I'm the dumbest guy in the world. I just lost $2.5 million. Like that, gone. I've been hacked." And I mean, he was calm and cool and collected by it, but not really. He has a bunch of gold and silver, but he had to sell it all. Ironically enough, he wanted to go back into Bitcoin and do it right this time, or into crypto. And I said, "Of course, I'm here for you." But my point to you is that this is a sophisticated guy that was early and lost $2.5 million just like that. Honest to God. And I don't know. I mean, as things get more and more advanced, you know, it's not even Bitcoin that I'd be worried about, more the banking system. JP Morgan spends $1 billion a year, or did a year or two ago, $1 billion a year for cybersecurity. So, you know, what about everyone else? If you're not a major bank, everyone else who's conducting any form of custody on behalf of a client. I mean, what kind of security are you going to have? And if you don't have the ability to have that kind of security, can you really offer a digital platform? I don't know. I'm just asking.
Yeah, to your point, and it's not just the banks; it's all of these, institutions. And it says a lot that the Fed and the Treasury Secretary needed to convene this emergency meeting, saying, "Hey, guys."
How about the small regional banks? They don't have
Yeah.
$1 billion to spend a year on cybersecurity. I mean, it's a big problem. It's a big deal, and it's being glossed over. And when you see quantum computing chips that can Google Willow, read it. Google the Google Willow chip.
Well, it sounds like this Anthropic model is more of a
It's the same
concern. Yeah,
thing.
but basically that we're not keeping up with the technological advancements in a digital
Or
system
we're not being told the truth.
that may collapse.
A single $2.5 million loss can reveal more about systemic risk than a dozen polished bank earnings calls. As Andy Schectman points out here, even sophisticated investors can lose everything instantly when digital security fails faster than safeguards can respond. JP Morgan may spend $1 billion annually on cybersecurity, but smaller institutions cannot match that protection. That leaves a dangerous gap between the safety customers assume and the resilience many financial platforms can realistically provide.